Overnight, Indian IT woke up to a storm. Tweets, TV tickers, trader chatter. Trump to slap tariffs on Indian software. Is that true or just noise? Today, we separate signal from speculation and map what could really change your contracts, your pricing, and your hiring plan. The frenzy started when Peter Navarro, a long-time Trump trade hawk, amplified a demand to tariff foreign remote workers and to treat outsourcing services like imported goods. That single social post lit up India's tech WhatsApp groups. And adding fuel, activist Laura Loomer claimed the president is considering blocking the US IT companies from outsourcing to Indian companies. This is not yet a policy announcement, but it did crank up the anxiety levels. So here's the reality. As of today, there is no official US tariff on Indian software services. What is real though is a new bill introduced in the US Senate called the HIRE Act, brought in by Senate Bernie Moreno. The text matters, so listen carefully. The HIRE Act proposes a 25% excise tax on outsourcing payments made by a US company to a foreign company if the end customer of that service is in United States. On top of that, the US firms would not be able to claim a tax deduction on these payments. The money collected would flow into something called the Domestic Workforce Fund. And if it passes as written, it kicks in for payments after December 31st, 2025. Now, what does that mean for us? It means that many Indian IT invoices heading to American clients could suddenly face a federal tax overlay of 25%, or the companies would be forced to restructure how delivery models and contracts are designed. And this isn't just about text on paper. Remember those White House summits? Trump sitting across from Fortune 500 CEOs, looking them in the eye and asking, how much are you going to invest in America? That is the philosophy. Bring jobs back to US. And the HIRE Act is that philosophy written into text code. Meanwhile, on the good side, the hammer has already fallen. The US has raised tariffs on Indian merchandise to as high as 50%, citing Indian oil trade with Russia. And in a high-stakes gambit, Trump has urged the European Union to join in with tariffs of up to 100% on imports from India and China to squeeze Moscow's war machine. That is still a request, not European law. Bottom line so far, tariffs on goods are real, but there is still no enacted the US tariff on software services of India. The HIRE Act is the live policy vehicle that would hit outsourcing if it moves. Now, the main important question is why Indian IT is getting nervous. The US is the profit engine. Media estimates peg India's IT and IT-enabled services revenue in 2024-25 is north of $200 billion, with half of that, approximately 50%, tied to US. Even a whisper of 25% levy shakes up renewal cycles, pricing sheets, and client confidence. And India's own chief economic advisor has warned that the wider tariffs environment could shave growth by significant basis points, service tax on top, and you're staring at serious boardroom headaches. Now, how would this excise tax bite in actual practice? Let's understand that. First is scope. Any fee or payment to a foreign person for working benefiting the US consumers could be taxed 25%. That is countries agnostic on paper, but India is the biggest target by volume. Apportionment or allocation. Mixed market invoices can be prorated. If a delivery center serves the US and the non-US users, the taxable slice tracks the US share. No deduction. The US companies cannot deduct these payments for tax purposes. That makes offshore delivery significantly less attractive on a cost basis. And remember, this is not a tariff under WTO, World Trade Organization rules. It's an excise tax buried inside the Internal Revenue Code. That's what makes it possible to target IT services. So who wins and who loses from all of this? Let's understand that. If the bill passes, the US client see their offshore cost base rise, and that will push more spend into local hiring or captive centers within India, and thus which can structure contracts differently. Now, for Indian vendors, it means scrambling, diversifying toward Europe and Asia, or shifting roles closer to the client onshore. If the bill stalls, the heat shifts back to the confirmed good tariffs and the looming EU tariff threat. But even that dense sentiment pushes the rupee and changes how we price in dollars. So here's exactly where we stand today. A Hire Act draft that proposes a 25% excise tax on outsourcing, that is confirmed. Tariffs on Indian goods have already doubled to 50%, confirmed again. The US is pressing the EU to slap 100% duties on India and China, that is also confirmed. What is not yet confirmed is that any official US tariff specifically on Indian software exports, Navarro's repost and Loomer's statements are not government policies. So the most important question, what should CIOs and CFOs do right now? First, audit your contracts. Tag every scope of work where the end customer is in the United States. And then you run a model with a 25% overlay. Second, look at structuring options, nearshore centers, onshore pods, or even global capability centers that shift how services are booked. Third, bake volatility buffers into renewals. The EU angle could reshape the sentiment and exchange rates overnight. And finally, communication. Have clear talking points for the US clients. Show them you understand the difference between rumor and a bill text. And tell them exactly around December 31st, 2025, such a tax could theoretically kick in. And here's the bottom line. Ignore the noise, but do not ignore the risk. Goods tariff are already real. A services excise is written into a bill, but not yet law. Indian IT has always survived by being agile. This time, agility will mean tax modeling, contract design, and even a sharper global strategy. Stay alert, stay prepared, because when politics turns into policy, the first place it shows up is on your balance sheet.